You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody, and welcome back to the Infinite Banking Mastery Podcast. Should I get competing illustrations? This has come up with people I've spoken to a few times recently, so I thought I would elaborate on this. I've talked to some friends in the industry who don't seem to come across this as much as I have, but in recent years, with more people discovering this concept, it's been coming up more frequently. So let's go over it. Most of you listening have been researching this topic, reading what you can, and just trying to understand the infinite banking concept to the best of your ability. And I think a lot of you might think or believe that you can learn it all the way, and you want to be fully knowledgeable before implementing the concept, which I think is great. I think it's great for you to be learning actively and researching and really trying to understand. That's exactly what you should be doing so that you are comfortable and you understand what you're doing for the most part. But I do think it's going to be nearly impossible to fully learn as much as, say, I would know. Unless you live and breathe IBC like I do every day, you're really just not going to know it all. I have been specializing in this concept for almost 15 years, and I still learn stuff all the time. I have a chance to talk to my primary company's chief actuary about 2 to 3 times a year and, only get to visit for about 5 minutes each time. But I learn something new from him just about every conversation, and I'm super grateful I get to talk with him even that often. In the midst of learning and trying to understand, some of you want to try and get illustrations from a bunch of different advisors. Some advisors are willing to send illustrations out, and some require underwriting before they will send out any illustrations. But even if all the life agents were willing to send you an illustration and you gave them all the same annual premium to work with, I'm quite sure that they would all come up with something different. When it comes to selecting who to work with, my best advice is for you to choose the person that you would most like to work with, who you feel is very knowledgeable in the infinite banking concept, who will be a good coach to you, will build a solid policy for you, and who is looking out for your best interest, rather than simply trying to compare illustrations. For one thing, some companies will illustrate better than others due to the dividend. And remember, the dividend is not guaranteed. And that's a big part of what will cause an illustration to look more appealing than another. More importantly to me is the guarantee, because the dividend will differ from what you see on the illustration over time. Oftentimes, the companies that are able to offer a higher dividend are also taking a greater risk to be able to achieve higher dividends. And I've said this before, but my whole life policy is not where I want to go for risk. Some companies even allow the agent to illustrate the rate that they want to show. This happens more often, I would say, for index universal life policies, but I've also heard that it's been possible at some companies for whole life policies. So always keep in mind that illustrations are basically guaranteed not to happen because the dividend cannot be perfectly projected into the future. And of course, there's agents out there who are running illustrations with index universal life policies, which are a completely different product and don't come with dividends in the first place. There are also other things to consider besides sheets of numbers, such as the loan process. Some companies require the interest upfront, for example. Some will ding you more than others when taking a loan, and some have a fee on the paid-up additions, even as high as 10%. Some are not as flexible when you can take a loan after funding your premium or maybe in that first year. It's just different with different companies. And so there are a lot of differences, a lot more than what I've mentioned, that can happen with different companies and different contracts at different places. As far as the policy is concerned, the most important element to your success will always be your actions and how honest of a banker you are and how you're treating your account, how you're paying it back, how frequently are you covering the interest, rather than just which company you choose to work with. As long as it's a mutual company, you are in the right place. If you were to ask a handful of agents to send you an illustration and they were willing to do so, each illustration will look different based on the amount, how much is going into base versus paid up additions. If there's a term writer being used on the contract versus not having a term writer on the contract, whether a term writer is even needed in the first place. Some will say it's needed and some will say it isn't. And with different companies, different things will need to happen. Some will add the disability rider, that waiver of premium rider that I've spoken of before, which would cover your base premium if you were too sick or too hurt to work. And other advisors would not add that rider. And there are also other riders that other advisors might add. Advisors also won't always agree on how much should be going towards the base premium versus the paid up additions in the first place. I know I have my reasons for the structures that I build or the starting point for building a policy, and I know others do as well. One of my reasons is for your protection so that you don't have a giant tax bill end up at your doorstep on your 80th birthday. That would not be pretty. You wouldn't be too happy. Another of my reasons is so that you have flexibility with your paid up additions so that you may continue funding the paid up additions as long as possible. I want to make sure that you have the ability to continue funding the policy as long as possible, as in the base premium, even though you may think you will want to stop funding it completely in 10 years or so, as I've heard from some people. By the time you get there, you are likely to see how amazing the policy is and probably want to keep funding. You may not want to take your foot off the gas just as your policy is starting to take off. And another thing that I know I've mentioned before is that some policy structures can be at MEC risk, at risk of becoming a modified endowment contract, even though the illustration may not state a MEC or show that it will do so. Which brings me back to my primary desire and concern is your protection. And some agents out there are just building illustrations to try and beat other illustrations. That should definitely not be your goal. I would even almost say that every advisor could probably beat every other advisor's illustration if in a competitive situation, but that doesn't mean it's in your long-term best interest. Therefore, back to what I started with, I would say that you should select your advisor or your agent based on the advisor who will be able to coach you to be the best banker you can be. The value is in the advisor, and the structure of the policy should be based on your current and future goals. Advisors competing with illustrations will just get you something completely different from each one that may or may not be in alignment with your goals. Each whole life product was created by actuaries and will have different features and flexibility as well. It's all about your actions as the banker and getting started in the first place, and as soon as possible, since time is your greatest asset. And if you're sitting there listening to this and you're realizing that a year or two has already gone by since you started learning and researching this concept, and time is slipping through your fingers as we speak, and therefore you would like to get started and would like to partner with me as your advisor, you are welcome to reach out to me. You can reach me at valerie@alphaomegawealth.com, and I will get you my calendar link to set something up. I hope you all have a fantastic rest of your week.
This is thepodcastfactory.com.